Welcome to this explainer. If you've opened a real estate app lately and felt an overwhelming urge to literally throw your phone across the room, you know exactly what we're talking about today. Something feels completely broken. So we're tackling a massive, incredibly frustrating question. What FTF just happened to the housing market? We're going to completely strip away the industry spin, decode the actual hard math, and look exactly at the structural forces behind this totally frozen market.
Let's get right into it. Okay, let's dive into this impossible paradox. Right now, the United States housing market just posted its lowest transaction volume since 1995. Think about that for a second. Fewer homes are selling today than at any point in nearly 30 years, even though we have 100 million more people living in the country. But look at the other side of the equation. Home prices are sitting near all-time highs. In any normal market, those two things cancel each other out, right? That is basic 8th grade supply and demand. But right now, those rules seem entirely broken.
So, if you're frustrated, your frustration is completely justified because something is deeply structurally wrong out there. Our goal today is to trace exactly how we got here using only the hard math. We'll trace the domino effect, unpack the mortgage hostage situation, look at the real human cost, break down the structural squeeze, dismantle the 2008 bubble myth, and finally chart a path through this new normal.
Section 1, the domino effect, a 5-year chain reaction. What we're seeing today is the output of a very specific sequence of decisions over the last 5 years, and this brilliantly illustrates exactly what that timeline did to your wallet. $730. Let's break down what that actually means. If you bought a $400,000 house in January 2021 with a 2.65% interest rate, your monthly payment was roughly $1,293. Today, if you buy that exact same $400,000 house with a 6.5% rate, it costs $2,023 a month. That is a $730 difference per month, every single month, for 30 years, for the exact same house with the exact same yard. It's literally a completely different financial planet.
So how did the dominoes actually fall to get us here? Let's trace it. The first domino fell in 2020, when the Federal Reserve slashed rates to essentially zero, pumping incredibly cheap pandemic money into the system. Then, in 2021, remote work exploded from under 6% to over 18% almost overnight. Suddenly, your apartment was your office, and people realized they didn't need to live anywhere near their workplace. This fueled massive demand. Then came the final domino. Rapid inflation hit, triggering the historic Fed rate hikes of 2022, which was the fastest hiking cycle in 4 decades. That remote work shift caused a literal stampede. Millions of buyers left expensive coastal cities for previously affordable ones. Between March 2020 and March 2022, which is just a 2-year window, mind you, prices in Austin climbed 61%, Phoenix jumped 59%, and Boise shot up 53%. We saw unprecedented price spikes simply because a massive wave of buyers, armed with cheap debt, descended on markets that had incredibly tight inventory. Then, to fight the resulting inflation, rates absolutely skyrocketed. By October 2023, mortgage rates peaked at 7.79%, the highest level we've seen since the year 2000. And here is the brutal math behind that percentage. With every single quarter-point increase in that rate, roughly 1.4 million potential buyers were pulled out of the market entirely. They didn't just decide to wait it out. They could no longer mathematically afford to buy. Demand completely collapsed.
Section 2, the mortgage hostage situation, the lock-in effect.
Now, what's really interesting about this slide is what happened to prices when that buyer demand collapsed. Basic economics tells us prices should have fallen, right? But they didn't. To understand why, look at this. 51% of all outstanding U.S. mortgages currently carry a rate below 4%. Half the market is sitting on a financial instrument that simply no longer exists. If you locked in a 2.75% rate in 2021, the market cannot offer that to you again. It is gone forever. And that creates a massive hurdle, represented by this number right here, $65,000. The Federal Reserve estimates that this is the pure financial penalty, on average, to trade an old, low-rate mortgage for a new one today. You'd be paying $65,000 in pure interest just to leave your current house. So what happens? Rational homeowners just stay put. They are effectively trapped in homes they've completely outgrown, not because they want to stay, but because a spreadsheet is physically keeping them there. So supply collapsed. At the exact same time, demand collapsed.
Section 3, the human cost, Maya's math. To really ground this macroeconomic data, let's introduce a relatable persona. We're going to call her Maya. She's 31, a healthcare worker making $74,000 a year, which is solidly above the national median. She has zero credit card debt, a great 760 credit score, and she's sacrificed for 3 years to save $31,000. By any standard, Maya is exactly the financially responsible person homeownership was designed for. But let's run her numbers on a median $385,000 home in her city. Her take-home pay is $4,650 a month. With a 6.5% rate, plus property taxes and insurance, her total monthly housing cost hits $3,010. That eats up an unbelievable 65% of her net income, leaving her just $1,640 for food, utilities, student loans, and, actually living her life. She cannot afford this house. This objectively proves the gap is structural. It is not a personal failing. Millions of Mayas are being quietly excluded by numbers that just do not work. And this generational squeeze leads to a shocking reality. 40. The median age of a first-time homebuyer has jumped to 40 years old. Back in the early 1990s, it was 28. This isn't just some quirky data point. It shows a massive structural barrier. The defining marker of middle-class stability, buying your first home, has literally been pushed from early adulthood way out into middle age because of these exact mathematical constraints.
Section 4. The mathematical structural squeeze. By the numbers.
Let's zoom out from Maya's story to the broader macro numbers keeping the entire U.S. market in this deeply constrained frozen state. To comfortably buy the median-priced home at today's rates, you need an income of around $106,000. But the median household income, it's only $83,700. That means the average American family faces a built-in $22,000 deficit before they even walk into an open house. The system is mathematically stacked against the median earner right now. Let's move to and see how this builds into an even bigger problem, because it's not just interest rates. The United States is currently short 3.5 to 4.5 million housing units. This shortage didn't just magically start in 2020. It's the result of a 15-year underbuilding crisis that started after the 2008 crash. Builders pulled back hard, and the traditional starter home, which is the typical entry point for first-time buyers, saw its construction plummet by 80% since the 1970s. We simply do not have enough houses.
Section 5. Why it is not 2008. Dismantling the bubble myth. At some point in every single real estate conversation today, someone says they're just waiting for a 2008-style crash. We need to address this common misconception head-on, because waiting for a crash to bail you out is a fundamentally flawed strategy. Looking impartially at the source data, it paints a very different picture. In 2008, risky subprime lending made up 18 to 21% of all mortgages. Today, it's just 3.6 to 4.2%. Even more telling, in 2009, 26% of all mortgage properties were underwater. Today, that number is just 2.2%. The 2008 market was incredibly fragile, built on bad loans. Today's market is deeply expensive, yes, but the lending environment is structurally sound.
And that structural soundness is anchored by this staggering figure right here, $35.8 trillion. That is the massive collective equity current U.S. homeowners are sitting on right now. This real equity is exactly why foreclosures in 2024 were only around 174,000, compared to a massive 2.3 million back in 2008. The borrowers are qualified and the equity is very real. The market isn't a fragile bubble about to pop. It's just a frozen market that is going to slowly grind sideways.
Section 6. Navigating the new normal. Math over myth. Because this is likely a multi-year correction of grinding sideways, we need actionable, data-backed strategies instead of just relying on false hope for a sudden crash. Here's the practical advice our sources suggest for this environment. First, run your real numbers, not the numbers a commissioned real estate agent gives you. Second, renting and investing the difference is a highly legitimate financial strategy. If you rent and put the difference into an index fund, the math can absolutely compete or even outperform buying an overpriced house. It's not a consolation prize. And third, if you absolutely must buy, explore new builds, where builders are offering legitimate rate buydowns to help the math actually work in your favor. So the crucial point is following strict criteria if you do decide to buy. Step 1, ensure your total monthly housing costs land below 28 to 30% of your gross income. If the math doesn't work at that threshold, it simply doesn't work. Stretching to 45% of your income just to get a house makes you a future statistic. Step 2, commit to staying at least 7 years. You need that time to weather this frozen, sideways market and actually build meaningful equity. Which leaves us with this final, incredibly important question to ask yourself. Are your housing decisions based on your real numbers or just the market's narrative? Don't let the real estate industry's "it's always a good time to buy" pitch push you into a bad financial corner. Trust your own math, understand the structural forces at play, and make the decision that actually works for you. Thanks for diving into this complex topic with me on This Explainer. Keep running those numbers, and I'll catch you on the next one.